Good afternoon, ladies and gentlemen. Welcome to the first panel of the afternoon. I'm very excited to introduce this panel of esteemed guests to talk about liquidity, a very, very important and relevant topic. We have with us our moderator, Hormos Faryar, the head of institutional sales at ADSS, Chris Hossein Nelson, the head of institutional sales at iX Prime, powered by Infinox, Christian Vlasianu, CEO of Centroid Solutions, Syed Abukarsh, partner at ARC Capital Management, and Mark Millington-Buck, the MD and head of international FX business development at Beerbaum Pro AG on Moscow Exchange. Let's give them a warm welcome to the stage. Thank you.
Thank you. Hi, everyone. My name is Hormos. As mentioned, I'm from ADSS, which is one of the brokers locally here in UAE, based in Abu Dhabi. And we got a panel today about liquidity and mainly FX, but we're going to touch other things as well, FX and CFDs. We've got a great group of panelists here, Chris, Christian, Mark, and Syed. I'm going to let them very briefly introduce what their companies do, and then we're going to go to a list of questions that I've prepared.
Hi there. Thanks for the introduction. I represent iX Prime, which is the institutional arm of Infinox, the well-known retail brand. But yeah, we are an institutional liquidity provider, FX, CFDs, cryptos.
That's iX Prime, not IS Prime. Sounds like IS Prime sometimes.
Don't do that, yeah. iX Prime. Yep.
iX Prime, okay. Christian?
Hello, my name is Christian. I'm the CEO of Centroid Solutions. We are a technology provider headquartered here in Dubai, and we specialize in technology solutions for brokers. Our solutions are catering for the core trading aspects that brokers require, namely focusing on bridging and execution technology, risk management systems, and hosting solutions for brokers. Our solutions can cater a wide range of customers, from the very startup brokers just entering the retail trading space, all the way to very large established brokers that operate with multi-asset offerings. So I'll be covering the technology aspect of liquidity.
Yeah. Mark?
Hello, my name is Mark Millington-Buck. I have two hats. I'm managing director on the board at Beerbaum. Beerbaum's been providing liquidity to the markets since 1956. Of course, originally as a voice broker, but more recently through technology and trading platforms. Moscow Exchange, obviously very strong on the ruble FX side. Like many exchanges, wanted to acquire a global OTC FX platform and acquired Beerbaum last year. So with two hats, one, I'm providing global liquidity to institutional clients. A lot of the brokers out here are sourced with liquidity that comes from our platform. And of course, the Moscow Exchange is the Russian capital markets and is the center of liquidity for ruble, alongside the daughter company of Beerbaum in Russia, which provides OTC liquidity for ruble.
Hi, my name is Syed Abukarsh. I'm CEO of ARC Capital Management in the IFC. We are a multifaceted company, asset management, as well as a brokerage arm supplying multi-asset coverage.
Syed, you're the only one based in Dubai. You're pretty much 5 minutes from here, so that's great. Thanks for joining the panel. Guys, I have done some questions, so I'm going to delve into them. So the first question is about FX liquidity. What's your company seeing kind of the last quarter in terms of FX liquidity, and also the fragmentation of FX markets, how top of book usually becomes smaller and smaller, etc. So what do you see in FX liquidity, volatility, Christian, the last quarters also in your company?
Right. So we have the access, let's say, across multiple brokers, so we can see what they are doing, basically. And we've seen that volatility has just recently surged back after a period of relative calm since late last November, let's say. So now we can see that it's quite volatile. However, also, if we zoom out in the period of last 2 years, we can actually see that it has been constantly quite volatile. and this has created greater interest from existing traders and also has generated more interest from new entrants that are coming to the market that have their eye on basically these increased returns. So volatility has been in general good, and it's definitely very good for both technology providers like us and brokers and liquidity providers, as it can have the potential of seeing much increased revenues. However, with volatility, there's also risk associated. The higher the volatility, the higher the risks. So that's why we've seen that a lot of brokers from the retail space have recently, over this period, been really keen in upgrading their risk management tools, risk management solutions, and it has become of crucial importance to have real-time automated solutions and controls to maintain yourself within the desired risk limits, because otherwise that can lead to quite significant losses, basically.
Great, thank you. And on the, do you see anything on the fragmentation side or anything in there? So this is a general, you see more volatility generally. Okay, not specific currency pairs. Chris?
Yeah, Christian's alluded to market risk, which is a great point. So as a liquidity provider, we love volatility. Everyone in this room, I assume, wants volatility. But what's been evident over the last year is very much that it's refreshing to see brokers are actually moving away from that desire for razor-thin spreads, huge top of books, 100% fill rates. They now look, and it's a testament that the market's matured. Everyone can give the tightest spreads, but now it's gone more towards offering a full package. So when there's increased market risk, you need to look at your LP's balance sheet, for example. Do they offer credits? Do they offer emergency credit? And that all boils down to communication and relationships. So I'll say, yeah, I think in terms of the market fragmentation, that volatility has created opportunities for mature LPs to deal with mature brokers. Because, yeah, I think those days of razor-thin spreads, we're all the same on euro-dollar. I know a lot of familiar faces in here. If your major selling point is 0.1 on euro-dollar, you're probably doing something wrong. Those days have changed, thankfully.
Excellent. Mark?
I think Chris and Christian are right. Liquidity is a lot more complex than people realize. Fragmentation, as a technology provider, you need to connect to more venues to provide the choice. But what you see more of is exactly what the guys are saying. The end consumers of liquidity are looking for a better match of liquidity for how they trade and how they consume it. And the technology companies have to stay ahead of understanding the developments in liquidity matching to really make sure that they're giving the best liquidity to their clients. In January, we had pretty good fill ratios on our platforms. Volatility was quite high, but we still had really good ratios. So our mismatches from trades not being filled were in the single digits, sometimes in the teens. When you get extreme volatility like we've had in the last few weeks, suddenly your clients are saying, why am I getting misses back in the 20, 30%? Well, volatility has that impact. So too much volatility means the quality of your liquidity can decrease. But there's technology available, and the liquidity providers, through the infrastructure that provide them, need to understand when they need to make sure they're adapting how they receive liquidity, how they challenge their liquidity providers to behave, how they control the liquidity providers to make sure that their consumers, their takers downstream, are getting the right liquidity to suit their doing their business. So fill ratios and management of fill ratios and having parameters to control the fill ratios, we think are as important as the risk management tools. Clients end up offside a lot of times and lose money because they don't get their trades executed. And they're not getting their trades executed because they're missing them. Did they put enough slippage into the trade to allow for the behavior of the liquidity provider? were they throttling all the thousands of updates per second from the liquidity providers, which wasn't necessary? So combining the right parameters in how you manage the liquidity today is becoming more and more important as we start to re-enter a high volatility marketplace. And making sure you have the right type of liquidity provider that immediately you're not offside is also important, but particularly in today's high volatility environments. Ruble, I've looked at the stats, we've moved into a 75%, 80% vol in the last few weeks. We peaked yesterday at 90%. It was off the charts. So trying to make sure that the infrastructure provides high quality streams of FX liquidity in ruble, which is one of our core strengths. It has its challenges, but we have the tools to make sure they happen. And in emerging markets particularly, you need to make sure that they are adopted. And that goes across all types of currencies, in all types of marketplaces, the lessons learned. And the fragmentation is a part of that, because you need to make sure you have a good quality source of liquidity so that across a fragmented source of liquidity, you can provide your clients with a good depth for them to trade.
Yeah, thank you. Syed, staying with this volatility and fragmentation, what's your thought?
I think maybe my perspective is a bit different from a general panel point of view here, is that I don't see volatility in FX markets at all. With the exception of some idiosyncratic stories like ruble, for example, recently, which I actually don't think has been that volatile, relatively speaking, to the potential of where it could have gone. Turkey, for example, we saw the volatility spike up last year. Again, G10 hasn't been volatile. There's periods of time when markets do move during switching hours. But if anybody who's been in this market for 20 years or 15 years will recognize that volatility is nowhere where it is or has been since we've been in this zero rate policy world. Now we're exiting that policy world, and now we're actually adjusting slowly. Market is slowly adjusting that. But one question I always ask myself, especially on the B2B side, is that how much of this liquidity and volatility that basically is being circulated out there is actually real and genuine and not recycled liquidity? And my answer to that, honestly, is I don't think we've seen that test. Last time we saw a test of that was in 2015 when the SMB had their event and we saw brokers fall aside left and right and center. So in this regime right now, which we're at, where basically volatility has been at near 5-year lows or 6-year lows, just picking up right now, I don't think that we're seeing true reflection of volatility, because most of the market right now in G10 space, or even the EM space, is mean reverting. And as we can all generally agree on, that mean reversion model works relatively well on a stream for the B2B business. Whereas I think the question is going to move away from spread and execution towards, can I get filled? I'll compensate certain amount of risk to get filled in the market. Spread-wise, I think this fascination that we've had over the past 10 years with getting the tightest possible price and execution done, yeah, those are great things in an optimal time when everything is nice and quiet. Those are great, fantastic things, getting the best fills possible. The problem is that now you're battling multiple things as a broker, as an execution agent. You're battling algos on both sides of the equation, which basically is fictitious liquidity. On the other side of the equation is that everyone's running similar type of risk models. 3, we haven't had a liquidity event in G10 that actually tests the mettle of the underlying liquidity of the underlying brokers in terms of capital ratios. So I think there's a great deal of leverage in this low vol environment just because it's low vol. But when that changes, I think that's when we really see a test of what liquidity is really out there. I think there's been a great expansion in liquidity. People are very dependent on liquidity, recycled liquidity, but I don't think we've tested it. And that test will probably come in the next year or 2 or 3. I'm not really sure, but it isn't what it appears to be. I don't feel comfortable talking about liquidity as a given in this market.
Yeah, I think some of you guys referred to high volatility. You're saying generally gold, CFD, equity indices are volatile, but FX is clearly not very volatile, right? I don't know if you looked at numbers. That's correct, right?
Yeah, no, they're all valid points that have been made. But there was a reference there to the Turkish lira, which was volatile in December, and we service a lot of Turkish brokers. And again, it goes back to this evolution of a LP. People don't look at the spread in real volatility. It's all about making sure that it's fill rates and realistic spreads, because, like I say, the market, if it's moving fast, you need a high fill rate, not a tight spread.
But we were promised high fill rates when I was in my 20s. You know, when I was a kid, 40 years ago, we were promised jetpacks and flying cars by the year 2020. 20 years ago, Mark, we were promised really good fill rates with technology. Now you're talking about, no, you know, rejection rates can go up if volatility goes up. What's going on? Technology. We were promised low fill rates with technology. Or is the top of book the issue?
No, I think a part of the issue is the fragmentation. And are you connected to a source market? Or are you getting flow that's been recycled? And if you have too much recycled liquidity in your book, then you need to be asking yourself, do I need to get the right liquidity for what I'm trying to do? And if you're matching your clients all the time with recycled liquidity, you'll find that the fragmentation and the volume that you want to get the trades done starts to cause you an issue. So you need to make sure you've got good core liquidity from as close to the source markets as possible whenever you try to do your trades. The more, let's say, intermediaries between you and your liquidity, then you start to see the problems of getting rejects. The closer to the market and also the behavior. One thing that's happened with technology is, as fast as you develop tools to overcome problems, you're also providing tools for the participants to change their behavior. So liquidity providers using TCA tools to examine the behaviors of their takers to say, the way you're behaving every time I trade, I'm slightly offside, so I'm going to widen my price to you. But then the takers say, well, you know what, the way you behave when you price to me, I'm going to throw you out because when I trade with you, I end up offside. And the ability for people to examine their liquidity more and more with sophisticated tools, and for that, the platform needs to support it, really means that people start to examine their liquidity more and more closely and better understand it. And I think that's a positive part of the evolution of the marketplace, as long as people take proactive steps and positive steps to make sure they're sourcing the right liquidity for doing the type of business they want to do. And if you're not doing that, that's when you start to experience bad fill ratios. You can get a client to quote you a nice, firm, tight price if he trusts you and he trusts what you want to do. And as long as you match him and behave as he expects you to behave on that trade, he'll give you a nice, tight price for a firm amount of time. You behave inappropriately, things get very different, and you start to see your fill ratios change dramatically. And it's about that I think is important, is sourcing the right liquidity providers from a fragmented marketplace to get it right.
Christian?
Yeah, I want to say that I completely agree, because we see that, of course, it's very important to aggregate different sources of liquidity in order to have maybe more depth of book and not so small top of book. However, the recycling of liquidity is indeed a big problem. And this is where the counterparties need to speak together and to analyze from both sides and be open about it in order to be able to tweak and achieve the optimal results. Technology can do a lot. You can have smarter order routing systems and quite a lot of configurations. But if, again, the liquidity is the same and it's just recycled along the way, it will not work.
But it's almost like you're saying, look, the high tech and the technology exists, but the problem's still there because, in my opinion, then the technology hasn't solved the problem of detecting recycled liquidity, or we're not there yet, right? We have issues with recycled liquidity. Everyone here agrees. Syed, how do you lower your rejection ratios? And is the technology, you've been doing this for a pretty long time. Is the technology really getting things done, and volatility and rejections are not a problem anymore in 5 years? Are we going to get there with tech? You execute.
Tech doesn't change anything, Hormuz. I mean, we can throw as much tech as you want to. I can go to a crypto conference and I'll hear about tech and how stable Bitcoin is and how every single thing is stable. Tech doesn't change anything. The underlying, if we're talking about FX, For example, there is a finite level of FX that takes place every single day. Let's not forget, this is basically trade flows, speculation, and there's a ladder of liquidity. Tech just multiplies the venues where basically brokers and other liquidity providers are trying to make a living effectively. Let's be honest about it. The more guys you have, the more tech you have, the more white labels you have, the more et cetera, et cetera, et cetera.
So technology is creating a jungle, you're saying?
Technology is creating a situation where you have a profile for market which is very much on a similar risk model, risk parameters, and effectively seeking liquidity simultaneously at the same time. That does not create a liquidity model. Me having a price of like point whatever it is and saying I have liquidity isn't that. I think we're going to move away from that eventually, where basically I can go out there in the market and hit 7 different banks at the same time, or brokers at the same time, and I can have no effect. And I can go on EBS or any other tool or dark machine, and I can go for a small amount, relatively speaking, and move the market. It doesn't mean that machines have any impact on the market. It's only about risk systems. So can I actually exit the market? And when you actually need to exit the market, not when you have to, but when you need to exit the market, it doesn't really matter what spread you're at. You have to exit. Simple as that.
Yeah, I mean, Saad's dream is to hit 7 banks at the same time and get away with it in the future. What do you think?
So there's some really valid points about technology, client behavior, I think was mentioned earlier. One of the lines I use all the time is that when you are a liquidity provider to a broker, you aren't a client of them and they're not a client of yours. It's meant to be a partnership. So it comes down to fact-finding and communication. Because we're all in this room, there's a lot of people, we're all humans. We sell from humans and buy from humans. So the technology is fantastic and it all works, but it comes down to understanding your client and also communicating better. Because when client trading behavior changes, we will never know why. But if you've got a good relationship and have open, transparent communication,
yeah, but relationship sounds like technology cannot help there, right? It's
yeah, I agree.
You know, I read in the news today that there is a new technology here in Dubai which predicts if a check is about to get bounced. So you get a check, you run it through this app, it tells you this check might bounce. There's a chance. So
was it your check?
we use checks here in UAE still. Yeah, but so. Yeah, so the technology question for me is just unbelievable, right? That you're saying relationship, partnership. So there's, in your opinion, in 5-10 years from now, this is going to stay. Syed, you agree, right? This is going to stay. We're going to have these problems in 10 years on this panel.
Again, I think one point that we have to stick about is basically technology. All it's helping to do is risk mitigation for that specific counterparty which is being hit. It's about risk mitigation. If I go out there and hit 7 banks at the same time, don't worry. Tomorrow morning, they'll all know I hit them at the same time, by the way. So it's about basically you're offsetting your risk to a risk taker on the other side. So, but I doubt that the venues that are across the world are all risk takers. And it's all, I mean, the thousands of different venues you can hit, or the hundreds or tens of brokers you can hit. The point is that all that risk has to end up somewhere. And either, for example, if I hit a large prime, like let's say Deutsche Bank or HSBC or Credit Suisse, for example, with like $50 ruble, that dollar ruble is going to sit there for 30 seconds. And if there's no matching, that machine is going to start offloading that risk. Now, if I hit 5 different guys after a minute and a half, then all of a sudden 5 different machines are going to be basically offsetting that risk at the same time. So the brokerage model or the risk mitigation model is even faster frequency and seeking more liquidity. The same model technology-wise applied across different venues is not going to change the liquidity dynamics. All it is going to change the movement in price.
Okay, understood. Mark, quickly, if you add something, and then we move on to the next thing.
Just to, if you're hitting Credit Suisse in 50 million,
he does it all the time.
You've got tremendous trust that Credit Suisse are going to wholesale that risk. If you hit somebody else in 50 million, you're going to see the market move tremendously. Ruble will move on a trade of 250,000, 500,000. A million is a large trade in ruble on the open market, and it's a very difficult currency pair to trade in. But Saeed's right. You find the right LP, he'll take 50 million in any currency from you, and you've got 30 seconds where you know that price is going to sit and be strong. And maybe they start to exit their risk, or maybe in Credit Suisse's, they've got such a big book in ruble that it doesn't move for them. But that's the point here. And everything says about technology. As clever as it gets, the more clever the participants get to try to use it, I would say, in a less positive way. And that's the issue with technology. As smart as you are to think about how can I use it in a positive way, people also think, well, how can I use it in a negative, destructive way, which offsets all the gains you've made in the last couple of years. And that's technology, and you have to stay ahead of that, and you have to keep people have to be continuously smart, and they have to evolve.
Yeah. Christian?
That's what I wanted to say as well, that I think a problem is also the fragmentation of technology. It's not a monolithical system that can work together and see everything. And it's usually technology versus technology. It's not a nice unified, environment.
Speaking of a nice unified technology, let's say MetaQuotes and MT4 and those platforms, they're dominating the retail space. Christian, what's your view on the future of this space? Let's say retail brokers and their platform dominated by Meta. What's the next thing over the next 10 years? Where do you see this going? Are we going to have one or two platforms dominating this retail space?
Well, if we are referring to, let's say, primarily FX brokers, we've actually seen since a few years now a lot of efforts of evolving, of diversifying into other asset classes. And in fact, there are quite a few examples right now that are what I like to call neo-brokers that come with their own technology. And they have an offering that span across multiple asset classes. They offer regional stock trading. They offer zero trading commissions, fractional shares, etc., cryptocurrencies, of course. And what I see is that they have actually taken the market by storm, so to speak, and encroaching on the market share of the so-called conventional MetaTrader brokers. And in my view, what they are doing is very significant, and we all need to watch that, because they are catering to a wider audience. It's not just the FX trading community, it's also the stocks and equities trading community, and it's also the newer generations of traders, the millennials, let's say, that have actually been exposed to trading and investing just recently through these hypes like Elon Musk, Tesla, cryptocurrencies, etc. So such a community is just much larger than just the FX trading space. And in order for retail brokers to maintain their market share, I think that it's a necessity for them to evolve to this multi-asset. And speaking about this evolution is not just about adding more products onto your existing platform or so. It has to do with much more, let's say, deeper change than that. You need to start catering to the requirements of these new traders. You need to have a solution that has a very simple and unified sign-on process, KYC, trading all these products from one unified environment, and solving the problems of having to deal with these multiple asset classes from one unified account. So there are many challenges actually that come with this, and I think that the current platforms are lacking a lot of features, and they need to evolve to that.
Yeah, Chris, is the multi-asset class story the way forward for brokers like yourself? Like that's the savior in terms of your MT4?
It's a good segue. We've just launched MT5 under our FCA last
Congrats,
week.
MT5.
But that's a necessity now, because I think years ago, we're showing our age, but it used to be you offered stocks, you offered Volkswagen just to get the DAX trader, and it was largely irrelevant. But now, like Christian alluded to, there are these young traders that they're all interested in the Apples and Teslas, and to old FX and CFD guys like themselves, it's a totally different world now. MT5 has opened up that world, and equity CFDs are now a necessary part of the selling process.
Can MT5 last you, let's say, 10 years, or you need next generation platforms?
Well, it's probably more a question for Christian, because as a pure price maker, all I care about is integration, and guys like Centroid, they do a great job making sure that we can access their technology. But yeah, no, MT5 is now just it is a necessity. And equity CFDs, every client wants them now, even though they may not trade them. They want to be able to say, "Yep, we offer X thousand CFDs."
Syed, have you tried MT5?
Yeah, I've tried MT5, but MT5, MT4, MT, whatever you want to call it, it's effectively part of the marketing spin, right? I mean, effectively, when Saxo or Money Garden came back in 95 and 94 with their first platforms, there was no algo, quote unquote. Now you have a plethora of algo providers, smart traders, blah, 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 et cetera, et cetera, et cetera. And that's why MT4, MT5 are so popular. Because I can go off the shelf, buy a program, plug it in, and it'll make money for me. Supposedly.
The EA execution
Yeah, I mean, it's effectively
ecosystem.
that's where the market share has grown tremendously in the past few years, and that's where now you have brokers on the other side actually looking at the post-trade analytics and seeing, okay, what's this model doing? Is he actually doing mean reversion? Is he doing breakout? Is he doing this? Is he doing that? The whole game is more complicated now because you have implementation strategies off the shelf, and you actually have effectively mafias of certain traders who are actually using MT5 or MT4, using certain strategies with one broker and a different broker, and it's become quite convoluted. But the fight for market share has become so pervasive that everyone's supplying it because they have no choice. But if you look at different brokers, they are supplying their own software, and that's on a multi-asset basis. I think that's probably going to be one aspect of the business, but MT5 will be here, MT4 will be here because the underlying off-the-shelf programming and the language is so pervasive now with traders and coders that it's here for quite a while now.
Yeah, MT5, maybe MT6 in 10 years.
But I think the real question, though, as a price maker, is equities are faddish, but they've been around for a couple of years now. It's been quite popular. But as a market maker, you've got to look at your cash management, because equities are extremely expensive in terms of money use or cash utilization. So whilst every broker's offering it now, in a couple of years, people may go, well, it's just not worth it. My return on investment, if I stick to traditional FX and CFDs, equities are nice, but is it winning me the real revenue?
Yeah, imagine, especially when FX volatility comes back, then you might step away. Well, a few people might step away from that asset class.
The second point is risk management. We're used to a 24/5 market. Shares close at what? They have finite hours, so the US is closing at 9, and we've got extended hours. But Apple reports a nightmare set of numbers, and you've got a mini S&B on your hands the next day. So it's making sure that your liquidity provider has a balance sheet to sustain that, and as an LP, making sure your client has the cash to pay up for it.
Yeah, Mark.
Well, put the exchange hat on for a while. I think the exchange employs thousands of people because equities are a heavy lift. They require custody, they have corporate actions, you have voting, you have dividends, you have subscriptions, and that has a lot to carry. As the world evolves with technology, digitalization, digitalized securitization, tokenized settlement, that improves, and those asset classes come back and go away. And it all comes down to people want to trade what's the cheapest type of asset that I can have, which has got some volatility, which can make me money. You talk about algorithms. You can track an algorithm online, and you can say, hey, I like that guy's algorithm, and you can just grab it. His algorithm is now freely available for you to run on your own system because it's just grab someone's algo. He shows his performance. He shows what he's doing, and you copy him. As the world evolves with technology and assets become easier and cheaper, they go in and out of favor. And people are smart, and they say, well, how do I get exposure to that underlying Tesla without having to own the actual stock? Well, that's where the markets, the CFDs and those sort of products come in, so you can have an exposure to the underlying without actually owning the stock. And that's where the digital world is coming in really, really fast, and you need to make sure that you keep up with that change in space. And as an exchange, that's something that we actively promote and get involved in, and we're very proud of the way that we provide our clients with a broad range of those type of products.
And if that's not enough, the asset class equities, then you invent a new asset class like cryptos, and you just go for it and let people trade it. So do you guys, I just want to go around and ask, do you guys do cryptos? What's your view on cryptos? And do you in terms of liquidity, what do you know about cryptos, and have you studied it, done it? Starting with you.
I've not studied it, but yeah, cryptos again. It's probably not going away. So ironically, iX Prime, we're just increasing our cryptos to 23 pairs and offering 33 to 1 leverage.
We got two guys on a panel tomorrow who are saying cryptos are going to go away. I'm going to ask them tomorrow. You're going to see this.
Yeah,
They're not going away. Most people believe, yeah.
Yeah, I'm not a crypto guy, but one thing I would say is I look at, I keep an eye on the legal case with Ripple or XRP, and if that does go past this SEC case, it does legitimise the crypto market. And then if there is an element of regulation, suddenly we'll be involved. But let's not be naive. Investment banks have been in cryptos for a long time. So we are the retail market is still catching up. And it looks like it'll be, there's momentum behind it, which will be difficult to dissipate.
Yeah. Christian, crypto, you must be doing something on the crypto side?
Yeah, certainly. Well, cryptos have been a very hot topic recently, and I think nobody can tell what's going to happen, if they're going to go away or not, or we'll see tomorrow. But I think that they are here to stay, at least for the foreseeable future. And what has been very interesting about crypto is that they have really opened up the interest into trading and investment to a greater audience than before. So I think that it's very important for brokers to make crypto part of their offering, basically. They are very risky assets, though. So I think that it's quite hard to make market on them without having very sophisticated systems. So what we see in general is that brokers usually prefer to have connectivity to crypto, to have assets on their platform, to execute trades back to back, and just get the commissions that are higher when associated with this type of trading. This is what I see.
So you guys have solutions for cryptos for brokers?
Yes,
for CFDs,
certainly.
I assume.
We from our side can support both CFDs and spot. It's not the bridging problem for that. It has to do with the trading platform, how that is being offered. But the most popular by far is CFDs. That's the easiest for brokers to get exposure into crypto assets. And you can achieve this through relatively simple integrations to crypto exchanges and other liquidity providers that specialize in crypto. And certainly we have had demand. We have implemented quite a lot of such integrations recently. And from what I see, it's still on our pipeline. So there are more and more to be added.
Yeah, Mark?
Yeah, Beerbaum's in Zug, so Swiss Crypto Valley. Obviously, we're fully engaged, fully up to date with providing crypto solutions. I think the interesting side is that this is an asset class that's been driven from the retail side, and the institutional clients, many of them are very ignorant about how they can access the market, and they don't know how to access the market safely. Or they go to their banks, and their banks are just not set up to provide any type of custody, and they don't know where to go to do that. So that whole space needs to catch up. And when that wall arrives, it'd be interesting to see if the liquidity, as we're talking about it, can keep up. I think it will. I think it'll stay. I think that crypto in some form will still be here. It may disappear in one form, but it'll reappear in another. One of the strong new products coming out this year, and not many platforms are supporting it, we are our NDFs and CFDs on crypto, because you take away the headache. Similar to equities, the cost of the custody, the cost of the settlement, having all the right mechanisms to securely put your tokenized crypto coin into a vault in the Swiss mountains, the Gotthard. If you can remove all that headache for the institutional clients, and you can remove it again even for the retail clients, then you provide products to the marketplace that they can move without the cost and the headaches. And I think that's where technology is moving ahead, and we'll see that next generation of digital asset trading coming through smarter and cleverer without some of the encumbrances of the usual problems of custody and solving problems like that. But you still therefore have to have an underlying market that survives for an NDF or a derivative market to thrive on. You can't have something that's purely driven by a derivative. It has to have an underlying liquid marketplace to operate.
Are cryptos, in your opinions, right now better than equities easier, less headache? Well, you have 10,000 employees running an equity exchange.
We have 4,000 employees purely looking after the equity market from terms of custody and
4,000.
Yeah. Yeah, we've got a huge national settlement repository that has an everyday job to manage all the corporate actions, all these things. So it's a large work for an exchange, and those come with costs. But as you can see, the marketplace moves on. It works out how to provide instruments. You give the market data. You create a marketplace that people can say, well, we'll trade without that. And so people use the data in smarter and smarter ways to create products, to create asset classes, whether it's a security in the form of an equity, security in the form of a digital coin. The marketplace is going to find ways that people can trade them for commercial purposes.
Great. Syed, do you guys do any cryptos at Arc Capital or any plans to do cryptos?
We're looking at cryptos, but not really sure what the future of crypto is. I'm definitely sure it's not going to be the same thing that we have today. I think right now crypto is in the middle of a battle with the investment bank culture, where basically crypto in the fashion that we know, basically a speculative vehicle, is evolving now into something more along the lines of an investment banking piece of paper, where it's taking the place of investment banks and raising capital. So the whole model of tokenization and backing our projects, that's really where the future of crypto, I think, is. It isn't just simply an asset class where you can move money from point A to point B via wallets. I mean, the real task would be, for that model, would effectively be maybe if the regulators were to say USDT and USDC are no longer allowed. That would change the market quite considerably for crypto. However, I think the evolving nature of crypto, and it's found various ways to evolve the past few years. You know, we went from just speculating on Bitcoin to payment solutions to now you have the whole funding aspect of crypto. There is an evolution here, and we're nowhere near the end of it. And I think just looking at it from saying it's going to end tomorrow is a bit too soon. I think we're looking at something evolving through our lifetime. It'll evolve more and more and more. Now, what shape ultimately it'll end up in is yet to be seen, but there's definitely an evolution in terms of funding that's taking place.
Yeah, so anything else to add, guys? We might have time for a question from the audience. Anything else to add on the crypto side, Christian?
I'd like to say that certainly the technology is very promising, and I also think that it's constantly evolving and is going to be here to stay. And what might be perceived as headache and operational overhead from brokers, because the crypto market is 24/7, it's actually one of the largest advantages and opportunities. Not only for trading, even there you can achieve constant interaction, constant engagement with your customers, but also the fact that everything settles instantly, around the clock and so on. It changes the paradigm of many, many things, really.
Just by being 24 hours.
Just by being 24/7, yeah.
24/7. Okay. Mark, anything else to add on the crypto and what you guys are building? And
No, I mean, there's a lot of things in the pipeline that haven't even come out yet. It requires some regulations to change, to improve. In the meantime, I think the consumers are smarter right now than the people who have got the ability to provide the infrastructure. And the infrastructure is having to keep up in a very, very fast-paced environment. We're very excited by the space. We're staying on top of it. We want to be a part of it, and we believe that it's definitely going to be something you have to have. And I don't know whether it's going to be a crypto coin in the form it's in right now, but digital assets, tokenized security is a part of the future because it reduces tremendous amount of costs. And the more we take costs out of the financial infrastructure, the more these products will trade. And that's what we're trying to do, is empower people around the world to trade, give everybody access and trade on financial instruments without the heavy burden of the infrastructure that encompasses it right now.
Makes sense. All right. So let's see if we have time for one question from the audience. Even a technology provider.
Hello, Tom Higgins here from Goldeye Crypto Switch. It's a question actually about traditional retail banks. Have they got a hope of surviving with their creaking ancient mainframe technology when we've been talking about this sort of technology that you have and that the crypto exchanges have?
You're asking if the banks are going to survive?
At the moment, if you try and do anything with a bank, their technology is so old, it's so difficult for them to achieve anything at all because they're so big and so tied up in knots. Can they evolve from that, or will new banks have to start? Will they have to spawn off something else to actually make it possible to do anything?
So on behalf of the banks, some of you have worked for banks. I know 3 of us have.
I'm not sure what the question is.
So are they nimble enough, pretty much, to keep up with the whole new? I mean, I agree that things are moving fast, and banks make decisions every 12 months or something. Like, are they going to completely be outdated, and a new generation of banks come? And where do you guys see the traditional banks heading? Do you guys see any issues with that?
I think if you stepped onto a trading floor in 2010, you'd probably see one trader for euro, one trader for yen, one trader for Swiss franc, one trader for sterling, one trader for EM, one trader for Scandies. I think today you step onto most floors in New York, London, Singapore, you'll find 1, 2 traders, 3 tops. The reason is because most of the flow, most of the transactions are now being handled electronically. Risk has been moved completely electronically to most. So if you actually want a real life quote, if you're a real player in the market and you want a real quote, so now thresholds have gone from, when I first entered the market, the threshold was for getting a voice quote was 1 million. And then it went to 10 million. Then it went to 50 million. Now, to get a voice quote off Citibank trader, 200. The point is, and that comes back to the question of liquidity. If you want true liquidity, you need a risk mitigator, somebody who's taking the risk on the other side. And banks feel comfortable giving a trader 200, 250 million risk as opposed to a machine because, as we have said before, or I said before, I believe a great deal of liquidity you see and the ability to monetize a risk still isn't at the same level from a trader's perspective to match it out as a machine. A machine can do it in tens, 3, 5, 10, 20, 30, 40, 50. But when you're going from real size, quarter and up, billion up, and you have to cover, a trader who can actually access various venues might do a better job.
Mark?
Again, it's a very complex answer. If you look back over the years, when you had the rise of the exchanges, the banks felt a little bit disintermediated. In recent times, and I'm going back a few years in recent times, the banks start to internalize all their flow. The more that they had to hedge out or the more that they had to give out back to the exchanges, they even lobbied for governments to bring in the concept of competitive choice. Europe, you could trade equities not just on an exchange, you could trade it on any sort of electronic venue that set itself up, and they started to create their own internal platforms. So the banks developed a huge way of internalizing all types of asset classes where they encouraged their clients to cross the spread. And they gave up very little back to the marketplaces. So what's the result of that is the big exchanges said, okay, well, we're going to start to disintermediate the banks. We're going to get the customers to directly connect to the exchanges. And we're going to allow platforms to develop which has led to the fragmentation, that marketplace can start existing outside of the banks. Are those marketplaces able to consume the really, really large tickets? That's going to be something we find about. But the banks still hold the route to the credit. For large corporates, large institutions, they do their FX through the banks because it's a part of the package that you want my credit, you have to do the FX with me. And they hold on to that like this. But they provide more and more, again, through technology, competitive solutions. They still need to source the liquidity as part of best execution. They still need to come to source liquidities to get it. They still need to plug into our infrastructure to get access to the marketplaces, and they still need to run their algorithms to do that. So there is becoming more and more realization that we need to work together Do we think everybody's working together on the same timelines? Absolutely not. Do I think the big banks will survive? They have to wake up quickly, and some are well placed to do that. They have excellent technology that allows them to do that. Others have slept for too long, and they know who they are, and they realize the problems they have, and whether it's too late for them to act, time will tell.
How about
But
this?
there has to be continuity to work together.
Yeah, I think banks are going to be around longer than the cryptos are around. How about that? Huh? What do you think?
Yeah, but banks have got the money, so they'll always be around. Yeah, it's just in what form they are.
Banks are going to be around longer than cryptos are around.
I think everybody's going to be around longer than me. That's all we need to know.
All right, that's it. Thanks, everyone. We've run out of time now. Thank you. Thanks to the panelists.